Hey, thanks for coming back, everybody. What we did here, this is your third accounting class period. And what we did here for the live students is we just took a quick quiz. Now, obviously, you folks at home, I cannot give the quiz to you. But we waited for you until we went over the answers to the quiz. So let's go ahead just real quick and go over the quiz that you guys took. For you folks at home, you might just even want to pause before we go over the answers after you see the questions and see if you were able to answer these, because these are very important concepts. Okay? So going over to the screen, the first question that I asked is, what is the accounting equation, right? What is the accounting equation? Assets equals liabilities plus owner's equity, right? Assets equals liabilities plus owner's equity. That always has to maintain equality, okay? Now, the other two questions that I asked are right here. What are the two things that cause owner's equity to increase? And what are the two things that cause owner's equity to decrease? Now, we know from the lecture, I'm going to switch over to the computer, the two things that cause owner's equity to increase are investments of assets by owner into the business and revenue, correct? Those are the two answers right there. And the two things that cause owner's equity to decrease are withdrawals of assets by the owner out of the business and expenses, correct? So there you go. You guys get that? Hopefully lots of tens. I want you to make sure you have those concepts in your brain. Again, we're trying to lay that foundation so we can start building more accounting knowledge on top of it. And today is a big lecture, so we'll go through some important stuff, okay? The first thing that I want to do, however, is I want to go through all of the homework that I have assigned that we have not yet gone over. And none of these will take that long, but let's go ahead and go through that, okay? First of all, I would like to go through exercise 1-2 and exercise 1-7, which I had assigned 2 class periods ago, but I didn't get a chance to go over, okay? So let's take a look at that. Exercise 1-2. Many accounting professionals work in one of the following 3 areas: financial accounting, managerial accounting, or tax accounting. Identify the area of accounting that's most involved in each. Okay, investigating violations of tax laws. Again, we're on exercise 1-2, page 30. Exercise 1-2, number 1, investigating violations of tax laws is what? C, tax accounting, okay? Number 2, planning transactions to minimize taxes is C, also tax accounting. Now, I will tell you, the general public largely confuses tax accounting with just general accounting, okay? When my wife and I go to parties and they find out I teach accounting, a lot of times they'll say, hey, I have some tax questions for you. Well, little do they know that I don't know much about taxes. I mean, I took the classes and, you know, took the CPA and passed to that section, did a little bit of that work in the private sector, but I never really liked taxes. It's a whole different ball game, okay? So some of you might have even taken this class thinking that we were going to talk about taxes. Not really, okay? The accounting that we learn in this class is really separate from tax accounting. You might take a tax class here at JCCC sometime, but it is 2 totally separate areas, okay? Number 3 on exercise 1-2. Preparing external financial reports is A, financial accounting. Number 4, reviewing reports for SEC compliance, also A, okay, financial accounting. Number 5, internal auditing. When we talk about internal auditing and internal users, we're talking about B, managerial accounting. External auditing, however, is back to financial accounting, A. Number 7 is cost accounting, B, okay? And number 8 is budgeting, B, okay? Do you see where number 7 and number 8, the costs of a company or the budgets of a company, those would be mainly for the people who run the company, mainly when people who work there who are internal. And again, that will be more in managerial accounting. Does that make sense? Okay. All right. I will put real quickly, and I will do this most of the times, just real quick on the Elmo. I will put those answers again for the folks at home to, if they missed one, since they can't raise their hand and ask me to go over another one. All right? So, the next one I want to look at is exercise 1.7, correct? Okay. All right, exercise 1.7, let's take a look. This is just matching, okay? Number 1, an accounting area that includes planning future transactions to minimize taxes paid. That is D, tax accounting, correct? Number 2, amount a business earns after paying all expenses and costs associated with its sales and revenues. That is net income, letter G. Number 3, on exercise 1.7, principles that determine whether an action is right or wrong. C, ethics. We don't get a chance, we don't have much time to talk about ethics in this class. Some of you might take a philosophy or an ethics class, and I encourage you to do so. We could spend a whole semester on business ethics. And when I got my master's degree, we did just that. We spent a whole semester on in a business ethics class. Suffice it to say, everything that we talk about in here, business ethics are somewhat foundational to it, right? If I had an accountant who worked for me, and she was an excellent accountant, she did great in her classes, she passed her CPA on the first exam, or the first attempt, all of those things, but you knew that she was unethical as the day is long, wouldn't you be a little bit nervous? Would you not? When you looked at reports that she prepared, wouldn't you be kind of thinking, I don't know, right? So ethics is certainly an underlying foundation to everything that we talk about. And we will address some of those issues a little bit more when we get to Chapter 9. All right? Number 4, accounting professionals who provide services to many clients. What is that? F, public accountants. And that's what I was for a while, for about 3 years or so. I was a public accountant, and I would go work for different clients. Okay? And number 5, an examination of an organization's accounting system and records that adds credibility to financial statements. We talked about that. That's an audit, okay, which is A. All right? So real quickly to put the answers up on the Elmo. There you go real quick. One thing I've noticed on this Elmo is that there's a shadow that goes right across it. So before next class period, I'm going to try to figure out how to get rid of that if it's at all possible. I made it worse, which is usually how it goes. Okay? So we'll look at that later. But there's the answers to exercise 1.7. All right? Okay, I think I also assigned Quick Study 1.7, Quick Study 1.8. Is that right? So let's go through those. All right, Quick Study 1.7. Use the accounting equation to compute the missing financial statement amounts A, B, and C. Okay. All right, in Company 1, if assets equals $375,000 and equity equals $250,000, then what do liabilities have to equal for that to remain in equality? $125,000. Okay. For Company 2, if liabilities are $90,000 and equity is $160,000, assets has to be $250,000, right? And then on 3, if assets are $185,000, liabilities are $60,000, equity has to be $125,000. Okay? Not too hard, right? And lastly, Quick Study 1.8. If the total assets of chartered company equal 500 and its equity is 320, then liabilities would be 280, right? Or did I? Oh, I'm sorry, I read it wrong. Yeah, 180. 180. 180 plus 320 equals 500. Okay? All right, and if total assets of Golfland equal 90,000 and its liabilities and equity amounts are equal to each other, what is the amount of its liabilities? 450, and equity is also 450, correct? So, real quickly, there are the answers. Let me back it up a little bit. Oh, wrong way. Right there in the middle. Quick Study 1.7, Quick Study 1.8. There are the answers. Okay? Any questions on any of those homeworks? Wasn't too tough, was it?
I didn't understand a lot, like about the difference between like tax accounting and financial accounting and stuff. I got a lot of those wrong. Like
Yeah. Here's the way I would, and certainly there's some overlap in those. The way I guess, and really, as far as you need to take it is this, is anytime it says anything to do with taxes, it's tax accounting. And I think both of those said something about taxes, trying to minimize taxes, or looking at tax codes or anything like that. But whenever it's in regards to, that amount that has to be paid to the government, taxes, it's tax accounting. Now, in regards to financial and managerial, mainly ask who's going to be using that information that you're preparing. If it's people that work within the company, like budgets, like the costs, it's internal, thus it is managerial. And if the primary users are external to the company, then it would be financial accounting. Okay? So maybe that helps a little bit. All right? Okay, the next thing that I want to do is take a look at the basic accounting equation one more time and kind of give you a precursor of where we are going to go today with this. Okay? All right. Let's say we know that, and I'll abbreviate here, assets equals liabilities plus owner's equity, correct? That always, always, always has to remain equal. That equation has to remain valid, correct? So a couple of examples. Let's say that you went and got a $5,000 loan for the bank, from the bank for your company, okay? You went to the bank, got a $5,000 cash loan from them, okay? Well, how would that affect the accounting equation? Well, cash would go up, and cash is an asset, right? So that would go up. What else would go up? Liabilities. Your debt would go up. You now have a liability for $5,000, correct? Now, do you see how, no matter if this was in balance before, this is going to remain in balance, isn't it? Okay? Let's say that you used $600 of that money to go buy a laptop for your business. Okay? You use $600 of that cash to go buy a laptop. Okay? Well, how would that affect the accounting equation? Well, one asset would go down. Your cash would actually go down by $600, right? But you would have another asset, namely computers or computer equipment, that went up by $600, correct? So nothing happened on this side. The net effect was 0 over here, but does the accounting equation remain in balance? It does, okay? It does. Now we're going to look through a number of those transactions here in a moment. But one thing that I want to do real quick is go forward in our slides a little bit to the expanded accounting equation. Okay? Now there is the basic accounting equation, right? Per our quiz, we found out, and we were tested over, the two things that increase equity. Those two things being investments of assets into the company by the owner and revenues, right? The two things that decrease equity were withdrawals of assets out of the business by the owner and expenses, correct? So we can expand this accounting equation a little bit, okay? We can expand this accounting equation a little bit, knowing that the two things, let me get my pointer here. The two things that, for instance, decrease equity, owner's withdrawals and expenses, those are subtracted. Okay, what does that mean? What that means is as owner's withdrawals goes up, equity actually goes down since it is subtracted, correct? As expenses go up, equity actually goes down since it's subtracted in arriving at equity. Does that make sense? Revenues and owner capital, this is where when you make your investments of assets into the business, this is what is affected. These have a positive relationship with equity. So as owner's capital and revenue increases, equity increases. But do you understand how this is kind of your expanded accounting equation? Now we don't use that as much as we use this one, or think about it, but I do want you to realize, and we'll emphasize this here in a second again, that with withdrawals and with expenses, since those are the two items that cause equity to decrease, when those items increase, equity actually decreases. Does that make sense? Okay. All right. Once again, boy, how many times have I said this? The accounting equation must remain in balance after each transaction. Okay? All right. I want to talk about, there are about 8 principles that we're going to learn about in this chapter. These are accounting principles. Now, what are accounting principles? Well, these are not the rules of accounting per se. These are more like the overlying principles on which these rules are based. Okay? Certain principles that always need to be followed in accounting. And all the rules kind of stem from those. Now, we're not going to talk about all these principles today, but we are going to talk about one of them. Okay? And that one that we're going to talk about, and I'm going to put a star by it because it's a really important one, is called the revenue recognition principle. Okay? That's the only one we're going to discuss today, I think. But it is a very, very important one. The revenue recognition principle. Okay? What that states is we recognize revenue when it is earned. Now, it doesn't say this on the slide, but let me ask this, or let me state this. We recognize revenue when it is earned. When is it earned? You might even, please add this as a note to the revenue recognition principle slide. When is it earned? The answer, when the product or service has been provided to the customer. Okay? We recognize revenue when it is earned. When is it earned? When we have given the product or the service to the customer. Now, notice what I did not say. I did not say we recognize revenue when we get the cash from the customer. That is not the impetus to us recognizing revenue. Let me give you a little example here, okay? This is a little bit simplistic, but I think this will help illustrate the revenue recognition principle. And this is the one that's kind of hardest for people to understand when they come into this class, because they're so used to thinking, oh, money comes in, that's revenue, right? Well, not always. And let me give you a couple examples, okay? All right, Gil. Gil's got $5 over here, right? Let's say that I am going to sell you this wonderful JCCC pen, okay, for $5, okay? Now, I'm going to give you this pen. You give me the $5, and I can now recognize $5 worth of revenue, okay? Because I gave you that pen. You with me? Seems pretty easy. Okay, let's do it again, but let's do it differently. Let's say that you say, hey, Dave, I need to buy one of those pens from you, okay? And I said, sounds good, they're $5 each. But guess what? I didn't bring any of them today. And Gil says, that's okay. Let me go ahead and pay you for it, and can you just bring it next Monday? Awesome. So he gives me the $5. Can I recognize revenue? No, I can't. Now think about this. He just gave me, he's one of my customers, he just gave me $5, and I do not recognize that as revenue. Okay? I do not recognize that as revenue. Because why? It is not yet earned. I have not yet provided the product or service. He gives me this $5, and I actually treat that as something called unearned revenue, which is actually a liability. And we'll talk about unearned revenue a little bit later. Okay? So he gives me this money. The weekend comes and goes. Monday comes, and I say, hey, remember the pin you paid me for last week? I brought it. Boy, it's a nice one. Okay? I cannot recognize the revenue yet. Not yet, not yet, not yet. As soon as I give it to him, boom, I can recognize the revenue. You with me? Does that make sense? Let's do this one more way. Take your $5. Let's say you say, Dave, I need to buy one of those pens. Okay, and I said, oh, I got one. It's a really nice one. You said, oh, I forgot my money. And I said, that's okay. Do you need the pen today? And you say, yeah, I really need it for all my classes. And I said, I tell you what, I'll give you the pen today. Just bring me the money on Monday. Can you do that? Sure. Okay. I cannot recognize the revenue yet. Cannot recognize it. Now I can recognize the revenue. I have given him the product. Okay. It does not matter when the cash exchanges hands. This is hard for people to understand. It does not matter when the cash exchanges hands. It matters when the product or service has been provided. So as soon as I put that pen in your hand, I can recognize revenue. The revenue is earned. Okay? The weekend comes and goes. I come in Monday and I say, how's that pen working out, big guy? You say, man, it's one of the best pens I've ever had. And I said, well, you owe me $5, right? Okay. So he gives me the $5. Now we're all even. Now when he gives me this $5, do I recognize revenue? No, I don't, because it's already been recognized, has it not? It was recognized when I gave him that pen. Does that make sense? Okay? We recognize revenue when it is earned, not necessarily when the cash exchanges hands. We recognize revenue when it is earned. When is it earned? When the product or service has been given to the customer. Okay? Question?
So when companies or businesses are doing their books, can't that cause a problem though? Because they give out a product and they have that on their books as...
What they have to show it is a liability.
Okay.
Okay? Let me give you an example. Now I'm going to, Gail, do you want to keep the pen or do you want your $5 back?
I'll take the 5.
Oh man, I was hoping you'd choose the other way. Let me give you an example. There's several products that we pay for, and this works with services too. This whole thing could have happened if, like, let's say I had a lawn mowing service, and I mowed your lawn, but you're not going to pay me till next week. As soon as I am done mowing your lawn, I can recognize the revenue, even if you haven't paid me yet. Let me give you some quick examples. There's a lot of companies that receive the money before they provide the product. Let me give you a few of them. Magazine subscriptions. You ever subscribe to a magazine? Usually you pay like $24 for 12 issues of Reader's Digest or whatever. They cannot recognize that as revenue. They have to show it as unearned revenue, which is actually a liability. Because they owe you either those 12 magazines or they have to refund your money. Okay? So if you paid $24 for 12 issues of Reader's Digest, every time they sent you an issue, they could recognize 2 of that is now being earned. Does that make sense? Another example. Let's say you pay $60 or $70 to go see some rock concert. Okay, at the Sprint, what's it called? Sprint Center, thank you. Let's say you pay $70. I went and saw Van Halen a couple years ago. It's a great concert. Okay? Now, when I paid my money to see that concert, and the concert wasn't for another 4 or 5 weeks. Well, if they would have canceled that concert, would I get my money back? Yes, and that's actually happened. It actually just happened with Aerosmith. Did you read this in the paper? You know what Aerosmith is? Yeah. Steven Tyler fell and broke his very large mouth, right? All that money that had come in for this year long of concerts, and that's a ton of money, is it not? That was all unearned revenue. I hope they didn't spend it, because they had to cancel the concert tour and refund all that money. You with me? Bummer. Okay? One other example is your car insurance. You probably prepay for your car insurance, don't you? And if you cancel your auto insurance and go with a different carrier, they usually refund you some money. Make sense? Again, revenue is recognized when it is earned. When is it earned? When you have provided the product or the service. You with me? All right, what I want to do now is I want to do some transaction analysis. One more time. The accounting equation must remain in balance at all times. Okay? So we're going to go through some transactions here and just show how this accounting equation always stays equal. Okay? First one. Let's say J. Scott invests $20,000 cash to start the business. Well, we know that when J. Scott, the owner, we know that the investing of assets into the business by the owner is one of those things that causes equity, owner's equity or owner's capital, to increase, correct? So what goes up here? Cash goes up, owner's capital goes up, okay? If you look at it in this sort of a format, looking at the screen, cash goes up by $20,000, and equity goes up by $20,000 because owner's capital went up by $20,000. Does the accounting equation, is it equal? It is, isn't it? Let's do another transaction. Let's say we purchased supplies paying $1,000 in cash. Well, cash would go down by $1,000, but supplies, which is also an asset, would go up by $1,000. So when you look at it in this format, cash goes down by $1,000, supplies goes up by $1,000, the net effect to the asset side is 0. And does the accounting equation hold? Yes, it does. Now, note something here. Sometimes people think on the accounting equation that since it has to stay in balance, that something has to happen to the left side and something must happen to the right side. Not always. Nothing happened to the liabilities and equity side in this situation, did it? Everything was on the asset side. So not with transactions, you don't have to have both sides of the accounting equation affected. You just have to have it remain in equality afterwards. And in this case, it does. Does it not? Third example. Let's say we purchased equipment for $15,000 cash. Well, cash goes down. That's an asset. Equipment, another asset, goes up by $15,000. How does that look? Well, just like as it's shown. Cash is decreased by $15,000. Equipment is increased by $15,000. Does the accounting equation remain in equality? It does, doesn't it? Fourth one. We purchase supplies of $200 and equipment of $1,000 on account. What does that mean? When we purchase something on account, sometimes it's also called on credit. What that means is we purchase this stuff, but we're going to pay them later. Okay? So we have established a liability. Specifically, when it uses the verbiage of on account or on credit, the liability that is affected is accounts payable. Not notes payable, but accounts payable. When we purchase something on account or on credit, accounts payable is affected. So, supplies goes up, equipment goes up, those are both assets, and your AP, your accounts payable, goes up. That's a liability. You with me? How does that look? Well, look on line 4. Assets goes up by 200. Equipment goes up by 1,000. And accounts payable also goes up by 1,200. Now, sometimes people get this confused as far as whether it should be plus or minus before these numbers. Well, think about it. Before we went to the store for this transaction, we had 1,000 in supplies. Now we have 1,200 in supplies, so it went up by 200. Before we went to this store with this transaction, we had 15,000 in equipment. Now we have 16,000 in equipment, so it went up by 1,000. Sometimes people will incorrectly say accounts payable minus 1,200. Well, no, we didn't have a liability before. Now we have a $1,200 liability. So accounts payable went up, didn't it? How would you make a liability go down, by the way?
Pay it off.
You pay it off with cash. Okay? Do these 4 transactions make sense? We're going to go through a few more here in a second. One thing I want to note, there's this concept called dual entry accounting. And what that states is that every transaction that you analyze will affect at least 2 accounts. It has to. Otherwise, if you did some sort of transaction that only affected 1 account, the accounting equation could not stay in balance, could it? So it has to affect at least 2 accounts. Now, the first 3 of these transactions we analyzed affected 2 accounts total. The 4th one affected 3. So it doesn't have to be 2, it needs to be at least 2. And I've analyzed transactions that affected 40 or 50 accounts. But the net effect was that the assets equaled the liabilities plus the equity when it was all said and done. Correct? Let's look through a few more transactions. We borrowed $4,000 from the bank. Well, cash goes up by $4,000. Notes payable goes up by $4,000. When you borrow, when it's an official loan from a bank, that is a note payable because there's probably interest involved. It's probably more formal. Some of you know this because you have loans from the bank for cars or for school. How does this look in our format? Notes payable goes up by $4,000 on the right side. Cash goes up by $4,000 on the left side. Does the accounting equation stay true? Yes. At any point, looking at the screen, at any point you can figure up the account balances and make sure that that accounting equation all stays good. You can make sure that 8,000 plus the 1,200 plus the 16,000 equals the 25,200, and the 1,200 plus the 4,000 plus the 20,000, that also equals 25,200, and these equal. Correct? Next transaction. Okay, let's say we provide consulting services. That's what our company does, and they pay us right away $3,000 cash. Well, cash goes up, and our revenues go up. Correct? How would that look? Cash goes up by $3,000, and our revenue also goes up by $3,000 over here. And that certainly will cause equity to increase because that's one of those things that causes equity to increase, correct? Questions on that? Next one. Now I want to think through this one. We paid salaries of $800 to employees. Okay, how is this going to look? Well, let's talk through this. Cash goes down by $800, right? Because we had to give that $800 out to our employees. And salaries expenses goes up. Okay? Salaries expenses goes up. Now, expenses are one of those things that cause equity to go down, right? I want you to look at the way that they show this there, but I don't really like the way that they show that. What they show is cash goes down by $800. That's correct, but I really don't like the way they show this. Here, switching over to the Elmo real quick, I really wish they would have done this way instead. I wish they would have, and how much was the amount? Somebody remind me? 800. I wish they would have shown expenses going up by 800, but then recognizing over here that those are subtracted in arriving at equity. Do you see what I'm saying? Expenses are going up. Expenses are not going down. However, when you look at the way that this format is shown, it looks like expenses are actually decreasing. They're not. Expenses are increasing. It's just that expenses are subtracted in arriving at your total equity. Does that make sense? So I wish they would have just shown this as plus here, but recognizing that eventually you're going to do this right here. So as expenses go up, your equity goes down. It's the same way with the next transactions on your withdrawals. A withdrawal of assets by the owner out of the business is one of those things that causes equity to decrease. So cash goes down by $500 in this instance. Withdrawals goes up, but we know that let me slow down. We know that when withdrawals go up, equity goes down. You with me? Again, the way that they show that, it almost indicates that withdrawals are going down. No, withdrawals are increasing. We just are eventually going to subtract those in arriving at equity. Okay? What I want to do real quick is this. I want to work on, in class, I want to work on exercise 111. Now, we will do this a lot. Go ahead and start turning to exercise 111. And what we will do for you folks at home is I want you to work on exercise 111 just like if you were in here in the class. What they will do is, while everybody here is working on exercise 111, they'll probably mute out our voices, and they'll probably play some wonderful music that you get to listen to while you work on it. Okay? But then we will go over it. Now, the reason I like to do this is because I like to have a problem that you've worked and we've gone over the answer. So when you do your homework, you're not doing the very first example of these. Does this make sense? You'll have one under your belt, so to speak. So, you folks at home work on exercise 111. Everybody here work on exercise 111. And we will get back together and go over the answer probably in about 6 minutes or so. Okay? So go ahead and do that. right, we are back. Now, for you folks at home, the wonderful thing is if you aren't done yet, you can just pause it, start us back up when you are done. Or if you get done early, you can just fast forward to when we start going over the answer. Okay? So let's go ahead and go over exercise 111. Now, the table shows the effect of 5 transactions on the assets, liabilities, and equity of Trista's Boutique. What are short descriptions of the probable nature of each transaction? Well, on transaction A, cash goes down by $4,000 and land goes up by $4,000. So most likely, they have just purchased land using cash. Correct? They have purchased land using cash. B, office supplies go up by $1,000 and accounts payable goes up by $1,000. So, probable nature there, they have just purchased office supplies of $1,000 on account, or on credit, as we might state. C, accounts receivable went up by $1,900 and revenues went up by $1,900. What have we done here? We made a sale and they will pay us later. We actually made a sale on account. So now think back to that revenue recognition principle. We can and we are recognizing the revenue because we have provided the product or service. They have not paid us yet, but we can recognize that revenue, and that's what we do right here. Accounts receivable goes up by $1,900 and revenue goes up by $1,900 because we have given them the product or service. In D, cash goes down by $1,000 and accounts payable goes down by $1,000. What do we do here? We paid off that liability. Cash left us, but our liability decreased. E, cash went up by $1,900 and accounts receivable went down by $1,900. What happened here? They paid us the money that they owed us. Now note this, class. In transaction E, do we recognize even any revenue? They've just given us, we have a customer giving us $1,900 in cash, and we are not recognizing revenue, and that's right. Why? We've already recognized the revenue. The cash is not the impetus to recognizing the revenue. It's when we provided the product or service, and that was back in transaction C. Okay? So I'm going to show you one more time the answers to this up on the screen, and at the same time, I am going to give you your homework assignment. Okay? Let me back up a little bit there. So I want you to do, now I have these in a little different order than they are chronologically in your book. I would go ahead and work this homework in the order that is shown up there. I think it's a little better to work them in the order that I've shown, okay? I think it'll be a little easier for you. So there's the answers one more time to exercise 111, as well as the homework that I want you to have due for next time. Make sure you're doing your homework, folks. This transactional analysis and being able to do it properly is a very, very, very important skill that we need to make sure we feel good about before we move on to the next step. Okay? All right, good class today. I know we got a lot of the stuff in, and we will see you next time. Okay? Good job, guys.